All right, well, we're going to go ahead and get started. Welcome, everybody. Welcome to the Arrive webinar where we'll be talking through taxes today. Our speakers are Joel Mezzastrano, our VP of Corporate Development, Jake Pruchno, our Director of Operations. And for those I haven't met yet, my name is Corinne Headland, and I lead our investor relations team here at Arrive. A quick disclosure before we get started. This is not a research report or investment advice. All opinions expressed in the webinar are those of our presenters, and past performance is not indicative of future results. I will say too, if you do have to leave early, we will be sending out a recording to folks, so you have this at the ready. A quick agenda for today. We'll walk through legal structure and tax advantages, rental income and capital gains, how this impacts single-family residential properties, so those long-term rentals, how taxes impact the single-family residential fund, again, a group of properties, our vacation rentals, taxes 201, so Joel will be taking it to the next level, and then we'll be hopping into live Q&A. If this is your first webinar, we tend to take questions in the chat. We'll either answer them in the chat or we'll tee them up for Q&A post-webinar, post-prepared remarks. So I'm gonna go ahead and welcome Jake up to the stage, and I'll see you all at the end.
Awesome. Thank you, Corinne. Well, we are going to start off slow since I'm not sure how many folks here have been longtime Arrive investors and who is just getting started with us. So as a quick recap, there's 3 different investment products that Arrive currently offers. First, there's the individual single-family residential properties, where you can invest in a single property that's rented out on a long-term lease. Then there's the single-family residential fund, where you can invest in a fund that owns dozens of properties, all of which, again, are rented out on long-term leases. And then there's the individual vacation rentals, where you own a single property that's operated as a short-term rental on platforms like Airbnb and VRBO. As we've continued to grow, we've adapted and added all of these different types of ways to invest in real estate, all of which come with their own special tax nuances and adjustments. So before we dive all the way into tax details, let's take a second to talk about the legal structure and ownership structure of the Arrive investments. The legal setup for all 3 of those Arrive products is the same. Investors are really buying shares of a limited liability company, and that LLC then owns the properties. With the individual property offerings, each LLC is owning exactly one property, the one that you're investing in. With the single-family residential fund, it's one LLC that currently owns about 30 properties and is constantly adding more. Now, an LLC is just a legal entity. It's not a tax structure. So the vacation rental LLCs are taxed as C corporations, and the single-family residential LLCs are taxed as real estate investment trusts, known as REITs. Each year, Arrive issues a tax form to investors based on which LLCs you own. Taxes are reported on a 1099 DIV, and we're planning to send a consolidated tax form that combines all of your Arrive investments onto one form. So taxes obviously come when you have earnings and returns from your financial investments. So there's 2 ways that investors can earn returns by investing in real estate. There's the rental income, which is the cash flow that's generated by renting a property out. And then there's the capital gains, which is the gain generated when selling a property for a profit. So let's start with the rental income. Each month, Arrive tallies up the revenue and the expenses for each property and then distributes that cash flow to investors. The dividends that you receive are reflective of the actual cash flow. How much cash did we collect from renting the property out, and how much did we pay out in expenses for a particular property? But not all of those dividend payments you receive from Arrive are taxable. That's due to depreciation, one of the biggest tax benefits of investing in real estate. Depreciation is a non-cash expense. It's an extra deduction that you earn simply for owning a piece of real property. What that ultimately means is that investors receive a certain amount of cash from Arrive each year as dividends, but the taxable profit is lower than the dividends due to this extra non-cash expense. Investors end up paying the taxes on the profits generated from each property, not the cash distributed. And the difference between those 2 numbers is the depreciation. So here's what that looks like on a sample 1099 DIV from one of our investors. So a little hard to see here, but this investor received $199.77 in dividends from Arrive in 2023, which is the sum of what's in box 1A and box 3. Of that $199, only $1.17 was considered taxable income, which is what shows up in box 1A at the top there. The other $198 is considered non-dividend distributions. And it's basically the dividends for properties that didn't have any taxable profit thanks to that depreciation expense. And now we'll talk a little bit about capital gains. In general, a capital gain is when an asset is sold for more than the owner's cost basis in that asset. Capital gains are highly valued by investors because they're generally taxed at lower rates than ordinary income. And there's three situations in which investors may have a capital gain with Arrived. The first is if you hold your shares in an individual property until the end of the investment period when we sell the underlying property. The second is if investors redeem their shares in the single-family residential fund. And the third is if investors are holding their shares in the single-family residential fund, but the fund itself is selling properties and generating capital gains by getting rid of properties that it already owns. If you still own your shares when the underlying property is sold, part of that gain may be depreciation recapture. This is a part of the capital gain that's taxed at a flat 25%. Now, when Arrived sells the property and winds down the investment entirely, that capital gain will also be reported on the 1099 DIV. Right now, the individual properties don't have any liquidity options, though we are exploring the idea of a secondary market. But in the single-family residential fund, there is a quarterly redemption option for investors. If the share value of the fund increases and you were to redeem your shares in the fund, you'd receive a 1099-B that shows your capital gain. This is slightly different than a sale of a property that shows up on your 1099 DIV, because redeeming your shares in the single-family residential fund is effectively a capital gain of your shares in the LLC rather than a sale of the property itself. And now I'm going to pass it off to Joel, who's going to go through some of the more nuanced tax details where there's differences between the single-family residential properties and the vacation rental properties and all sorts of other tax situations.
All right, thanks, Jake. Okay, so now we're going to cover some of the tax aspects that relate to investing in a fund, such as our single-family residential fund, but most of it also applies to our long-term rentals, which are funds of one asset. So whether in our single-family residential fund or individual properties, all of the long-term rentals at Arrived are taxed as REITs. So rental income is taxed at ordinary dividend rates, and capital gains are at the preferential capital gains rates. We are eligible as a REIT for the QBI deduction, which applies to this year and next year, and then the law is set to sunset, but it gives a 20% discount on the amount you pay on your rental income. So those ordinary dividend, the taxes on the ordinary dividends are reduced by 20%. And lastly, and one of the nice things about being a REIT is that we get to report our taxes on a 1099 div, which is about 1 million times more user-friendly than a K1, and it does not trigger any state filings based on where the property is. Everything is based on where the investor is located. So now our next topic is net asset value, also known as NAV. So first, just a general comment on finance lingo. It can be very confusing. Oftentimes, there's not a universally accepted definition of terms. You may have tax, accounting, securities that all refer to the same term, but it means something entirely differently. So back to the title of this slide, sometimes NAV refers to the value of a fund. So it's assets minus its liabilities, but sometimes it's also the share price or the net asset value divided by the number of shares. So NAV is important because our single-family residential fund is open-ended, meaning investors can continue to buy shares over time. We will update our NAV on a quarterly basis, and that's the price at which shares are bought and sold. And as Jake mentioned, there is a redemption program where investors can sell their shares back to the fund at the current NAV, although it's subject to some limitations and potential fees. So what makes NAV go up and down is fairly simple. When the fund generates income, like our rental income, NAV goes up. NAV can also go up when the value of the assets go up, even if they're not sold. So we will appraise our assets on a quarterly basis, and if the value goes up, then the value of the fund's shares will go up. And if we sell an asset for more than how much we valued it for, that produces an additional profit that'll also make the NAV go up. On the converse, NAV will go down if we lose money, if the assets go down in value, but NAV also goes down when we make a dividend because we're giving cash back out to our investors and reducing the cash in the fund. As just a very simple example, if the fund generates $1 of profit and it pays $1 in dividend to investors, and the assets in the fund haven't changed in value, then the NAV will not change. So now we're going to discuss a few concepts related to how the funds are taxed. So it so happens that REITs and mutual funds both happen to be taxed in a very similar way. Now, we've talked about in previous webinars that corporations do have some disadvantages from a tax point of view, and that they're taxed at two levels. The corporation pays tax, and then the investor pays tax on dividends. The other issue is that corporations do not get to pass on capital gains rates to their investors. But fortunately, both REITs and mutual funds are special types of corporations from a tax point of view. As long as they comply with the rules of the types of assets they hold and the types of income they generate, they get to pass through capital gains to their shareholders. And it's also on the simplified 1099 div. And it's also worth noting that our individual long-term rentals, again, are essentially funds of one home, and they're taxed in the exact same way. So say you bought into a mutual fund that was holding Microsoft and Tesla, and the fund sold some of those shares at a profit. You would get what's called a capital gains distribution on your 1099 div. Same thing would apply to a REIT. If you owned a REIT and it sold one of its properties for a profit and had a capital gain, you would get a capital gains distribution on your 1099. You know, one of the main differences between REITs and mutual funds is really just the assets they hold. And with real estate, as Jake mentioned, you may get non-dividend distributions due to depreciation, and it makes your cash flow higher than your taxable income. Also, when a property is sold, some of the gain is reclassed as depreciation recapture, which is taxed at a slightly different rate, but still a lower rate than your ordinary dividend rate. So we've created a few examples to help illustrate the concepts of both NAV and capital gains reporting. So say we have a very simple REIT. It buys two properties for $3 each, and now an investor buys in. So the NAV is $6, and the investor pays $6 for the shares. There's no tax impact of buying the shares. And then the next quarter, we revalue the fund's assets, and we've appraised them at $4 each. So now the fund NAV is $8, but there is no tax due because we haven't sold anything. It's just just because the value of the properties have gone up, there is no tax implication of that. That's one of the great things about holding real estate is you can hold it for the long term and there's no tax implication until the properties are sold. Now, if we turn around and sell the properties for the $4 that they're worth, we've made $2 in profit. And since REITs are required to distribute the profits, we're going to make a $2 dividend to our investors. And that dividend is in the form of a capital gain. So our investors will get a $2 capital gain. But remember, we said what makes NAV go down? If you make a dividend, it'll reduce the NAV. So we had it $8 before. We've made a $2 dividend. Now it brings our NAV down to $6. And if the investor decides to sell their shares at $6, they paid $6 for the shares. They're selling them for $6. There's no capital gain associated with that transaction on the sale of the shares. Now let's look at a slightly different example where just the timing varies a little bit. So here our REIT buys the same two properties. They go up in value. And now an investor buys in at $8, which is what the NAV is at that time. The fund goes ahead and sells those properties and makes its $2 dividend. Our investor is going to get a $2 capital gain, and it's sitting on now shares worth $6. If it then goes and sells the shares at $6, there's actually a $2 capital loss. So the gain and the loss offset each other. And again, it's just a matter of timing because the investor originally paid $8 for the shares and it sold them at $6. Now we're just going to talk about the differences in vacation rentals and how they're taxed. So vacation rentals are taxed as corporations. They are not eligible to be REITs due to the nature of the operations of a vacation rental. So corporations pay tax at the corporate level, and then whatever dividends they issue to investors, those are taxed at qualified dividend rates. And that's a lower rate. That's the capital gains rate. And the way the system is designed, if you take the tax rate that the corporation pays, you add the capital gains qualified dividend rate that the investor pays, and you add them together, it turns out that that's equal to the ordinary dividend rate. So the same amount of tax is paid in both cases. It's just divided between the corporation and the investor in the case of a vacation rental. Also, depending on where the state it's operating and the amount of profit that's generated, there may be some state tax due, but that's paid for at the corporate level. It's not the responsibility of the investor. And then because we're not a REIT, any of the appreciation in the property is at the qualified dividend rate and corporate taxes due. It's not simply a capital gain that's passed through to investors. But corporations, like REITs, do get to use the simplified 1099 reporting. And then lastly, we're just going to talk about a few different tax topics that come up from time to time. The first one is just the timing of dividends and taxes. So dividends are all attributable to a taxable year. And when we send investors their 1099 divs, it's all for a given tax year. The only timing exception is that if we pay a dividend by January 30th of the following year, then that could be tied to the previous tax year. And there's a lot of very strict rules around REITs where we have to pay at least 90% of our taxable income. So sometimes it'll be towards the end of the year until we figure out exactly where our income is. We may need to have that dividend paid in January in order to stay REIT compliant. As Arrive moves to monthly dividends, it's more likely that we're going to be compliant by the first 11 dividends of the year, and we'll be able to keep things where our tax reporting and the cash you receive in a given calendar year is in alignment, but there still may be some issues for compliance where we do need to pay a dividend in January that's attributable to the prior year. As far as 1031 exchanges go, this is a rule where the IRS will let you defer taxes by selling a property and rolling all the proceeds into a new property, and you would have to adhere to a whole set of rules. Unfortunately, the 1031 rules do not apply to REIT shares, so you cannot exchange a property for shares of a REIT. The IRS does not consider those two types of assets like kind. Now, if within one of our REITs, we sell a property, we can 1031 and do a new property. But again, the conversion of someone's individual property into shares of a REIT is not something that we can support. There are some structures that would allow investors to exchange into a professionally managed derived asset or fund. We're currently evaluating those for the future. And I think Corinne is putting a poll in the chat to collect some more user feedback as we evaluate some of these options in the future. In terms of IRAs, there are some complicated rules with IRAs, as always is the case with anything tax related. And sometimes IRAs, especially when they invest in real estate, it triggers an extra kind of tax, especially if there are loans that are used, any leverage on the real estate. Fortunately, REITs are exempt from this. It's called UBTI, or unrelated business taxable income. But if you buy shares of a REIT with your IRA, even if we use leverage on the property, it does not trigger any additional tax issues. Currently, we support checkbook IRAs and are looking into some other options for the future. And lastly, just a note on tax losses. So if you own a property outright or you're investing in a property through an LLC, you may get tax losses allocated to you, and depending on the circumstance, you may or may not be able to take advantage of them, or they carry forward to offset income in a future year. With a REIT, we cannot pass a loss through on the 1099 div. So a loss on the REIT, unfortunately, cannot be used to offset other income. However, the loss, 80% of the loss is carried forward to offset tax in future years. It'd be the same thing if you owned a share of Microsoft, which is a C Corp. If Microsoft happened to have a loss, you would not get a loss of it on your 1099 div. You'd only get a loss if the actual shares went down and you ended up selling the shares for a loss. But you're not going to get a loss from the operation of the corporation or the REIT. I think it's now time for Q&A. So Corinne and Jake will hop back on.
Lots of questions flowing through the chat now.
Absolutely. Well, Jake and Joel, thank you so much for prepared remarks. Absolutely fantastic. Now I'm seeing the wheels are turning from the folks that have joined in today. So thank you for all the questions that have come through. If they weren't answered in chat, we're taking them live right now. So feel free to have them come through. We'll be hyper-focused on tax-related questions today. So if it's more general Arrived 101, those are better suited for our Tuesday, Friday webinars. We didn't have our standard webinar at 9 today since we hosted this one, but we'd love to have you there as well. All right, the first one from Tiffany. And Tiffany, thank you so much for your feedback in chat in regards to how you would like to diversify and what you're looking for. Joel, I'll kick this one to you first. Are there any opportunities where we can invest without going through a REIT structure? I'm looking to generate passive activity income outside of real estate investment trust. I shared a little details in chat and they shared more details as to the why as well.
Sure. So as of right now, REITs are the only investments that we offer. Related to what we're looking into on the potential 1031 program, there may be related opportunities to invest in some other structures, but currently REITs are the only ones we support.
Fantastic. All right, moving back over to the chat here. Let's see. A good one from Stephen, and I saw, Jake, that you had answered some of this in chat as well. If I redeem some but not all of my fund shares, are you reporting a gain to me based on selling my oldest, more likely long-term gains, shares sold first, with the gain being the excess of the appreciated and depreciated value of the fund assets over the amount I paid for the shares sold? Joel, I'll kick it to you. Jake, I know you might have some color.
No, we are using, it's called FIFO, first in, first out, for how if someone is buys shares over time and they're selling some of them, is to determining which actual shares are sold. And yes, that does help get long-term capital gains status. And so the way that would work is you have the amount you paid for the shares. The non-dividend distributions will reduce your basis in the shares because that's effectively a return of capital. And then you would have whatever you sold, your net sales proceeds from selling the shares, and the difference between the two would be your gain or loss.
Fantastic.
Hopefully a gain.
Definitely. All right, moving back over to chat here. Let's see what we have. Does Arrive support DRIPs? Maybe Joel, you could walk through what this is to give folks an idea too.
I'll let actually Jake take this one.
Perfect.
Yeah, we don't have a dividend reinvestment program quite yet. We're getting ready to launch a similar variant called a DSPP, which is basically an auto invest program. And the way that'll work is that investors will be able to select kind of the maximum amount they want to invest in the single family and residential fund per month. And then every month it'll kind of create an automatic trade based on whatever the current price of the single family residential fund is. And importantly, it'll use any dividends that you have sitting on the Arrive platform in cash. So it isn't exactly a DRIP because it's not investing only your dividend amount and buying you up, fractional shares of the investment. It'll be more of an auto invest, but it'll be partially funded with dividends, which are getting paid out monthly. So it'll be the way to kind of automatically fund additional investments and start to compound the returns you're already receiving from those monthly dividend payments.
Fantastic. Yeah, great feedback. Definitely appreciate it, Mark. We'll be sure to share more as we move through. All right, moving back over to the chat. Bill had asked, if a dividend has to be paid in January for the prior year, does the 1099 DIV get issued after the January dividend payment? Joel, I believe you touched on this briefly.
It's really about the same time. We're required, I think we have to issue the dividend by the 30 days after the year in order for it to qualify for the prior year. That also happens to be the tax reporting deadline for the 1099 div. So they'll come out at the same time, but we will know what the dividend is in advance because we have to in order to calculate all of our 1099. So it's just the payment date. We have up until the 30th of January to make that payment.
Fantastic. Yeah, great question, Bill. Definitely appreciate it. Jake, good job on the questions in the chat too. I see you're answering quite a few there.
Yeah.
I try to help out as they're coming in.
Definitely. I can take this one from Cheryl. Is there an option for dividend reinvestment? It's a great question. At this moment, we do not have the option for auto investing, but you're more than welcome to invest your dividends as you get them. You'll essentially have a cash balance, and then you can apply it to any arrived investments. Whatever left over there is, it'll just pull directly from your bank account. For a little bit of context here, we previously had quarterly dividend payments. We moved over to monthly in January of this year. Based off investor feedback, is essentially what we wanted to mirror what folks see as a traditional property owner with rental income coming in. So we have monthly dividends as well as dividends paying to that balance. The reason that's important is because it's the foundation of what will unlock auto reinvestment or auto investing in the future. So Cheryl, you're asking a great question with all the folks on the line today that I'm sure are interested as well. All right, let's see what we have here. One from Ratul. Can you explain more about 1099 DIV Box 3 non-taxable distribution? Jake, I know you walked through the 1099, so do you want to take that one, or Joel?
I'll start, and Joel, feel free to pop in afterwards too. So that basically the dividends that you receive that are taxable show up in that box 1A. And if you don't have a taxable profit on a property, so say that the depreciation meant that you didn't have a profit, you actually had a net loss, those dividends that you're receiving aren't categorized as profits. They're categorized as non-dividend distributions, which is effectively a return of capital. So it's a way kind of on the tax basis to communicate that you're receiving cash, you're receiving payments, but it's not taxable. So what it ends up doing is reducing your cost basis in that investment. And that means that later on, you may have a larger capital gain, but in the short term, that depreciation is kind of shielding that income, meaning that you're able to receive those dividends without necessarily paying income taxes right now.
Fantastic. Which will let us know if there's any color or clarification there needed. Happy to jump in.
Nope.
All right. Oh, that's one in from Daniel. This is the first time, Jake, I think that, Angela, that we've talked about a 1099-B explicitly. Can you explain what it is and if I can expect to receive one? Jake, I'll kick it to you first.
Sure. So for right now, that 1099-B only comes into play if you go ahead and redeem your shares in the single family residential fund. So the way that program works in general is that investors, once you make a transaction, you need to hold on to those shares for at least 6 months. And after that 6-month period, you're eligible to submit a redemption request. And then Arrive basically batches them all together and quarterly then tallies up how many redemptions have happened and can liquidate investors at whatever the current valuation of the fund is. There are a couple of fees for early withdrawal. They're listed on the single family residential funds page. It's not meant to be an investment that's as liquid as a stock where you can kind of trade in and out. It's more of a way for investors to be able to have some liquidity, given that this fund is going to have an ongoing kind of time horizon as it continues to add properties. So for right now, you'd only receive a 1099-B if you say, hey, I've owned these shares for a year or two, and I'd like to redeem half my shares and use them to go fund something else. In that case, you would be effectively selling your shares in the single family residential fund. And so that 1099-B is the tax form that talks about, how much you've received from that sale so that you can report any capital gain on your taxes. We may also have this come into play when we develop a secondary market for the individual properties. So you can kind of buy and sell shares amongst investors. We don't have that available quite yet. So right now, that only option for the only situation in which a 1099-B pops up is in single family. You're muted.
I was saying, sorry, there's a big truck driving by, so I thought I could. All right, moving back over here. I know we have quite a few more in here, some awesome questions. I did see quite a few questions on depreciation. Maybe we double down on this. There was another question in here if depreciation applies also to the single family residential fund. Joel, do you want to take that one?
Sure. Yeah. So first, it does absolutely apply to the residential fund because it's just it applies to each individual home, and the fund is just a collection of the homes. As far as being able to take advantage of it, you are taking advantage of it already. It's just not visible to you. It's that when we report the taxable income to you, we have already taken a deduction for depreciation. So it's happening, you just don't see it. Sometimes if you own your own home or you're invested through an LLC, you'll see some of those details maybe broken out. But when you buy it through a REIT and you get a 1099 div, it doesn't, there's no requirement to break all that out. So we are doing that for you. And then, again, because you're seeing those non-dividend distributions, that's the depreciation in action.
And I'll double down on that because that's a common confusion come tax season is people expect to see a depreciation amount on their tax form. But like Joel's saying, by the time that you get your 1099, we've already factored that in. And that's kind of how, when we looked at that sample 1099 DIV, it really only had the taxable income and the non-dividend distribution boxes filled out. Depreciation itself doesn't show up in there. It shows up further upstream before we've even calculated what your taxable income is.
Fantastic. Wonderful. I do see some questions in here that are a little more catered for our standard 101 webinars. So if we have time, we can definitely jump to them, but we won't be able to cover all of those today in the taxes webinar. All right, moving back over to Rose. How can investors claim fees and operation costs of properties from taxes? Joel, I'll kick that one to you.
Yeah, it's really the same answer. We've already done all of that. When we compute the taxable income. So all of the expenses, the operating expenses, taxes, insurance, maintenance, property management, everything is already deducted when the final number comes out.
Fantastic. Yeah, great questions. Moving back over here, I believe we have one with the same. All right, here's one from Steven or Steve. Thanks for joining us today. I know they have a marathon coming up. If someone else redeems fund shares, am I correct that it won't affect me since they are paying a gain or loss based on that? Based on that, they bought the shares at the current value of the fund properties. Joel, I'll kick that to you.
Yeah, that's exactly right. So anytime something is transacted at the net asset value, if we sell more shares or the fund redeems shares, it doesn't change the value. It's kind of neutral on it. And whatever the individual investor's tax situation, whether they made a gain or loss on those shares, that's on their own personal tax return. That definitely has no impact on anyone else in the fund. If somehow we sold shares for more than the NAV, it would actually make the NAV go up slightly, but we are always transacting at the NAV. So it doesn't affect anyone else, whether we're selling more shares or redeeming shares.
Fantastic. Lisa, I saw you had a note in here about the biggest differences between single family residential properties, the SFR fund, and then vacation rentals. Our standard 101 webinar is a perfect resource for that. And then we also have a great article that Brett just linked in chat around a lot of the differences. But if you have a tax related question for those differences too, we're happy to jump through that as well. All right. Through all these various types of transactions, Arrive tracks investors' basis in the shares. Joel, I'll kick that to you.
Yeah. So I'll just take a step back, and if for those that have maybe a brokerage account and you get a consolidated 1099 at the end of the year, and in case you happen to read anything beyond the first page of it, you'll see that when you get when it reports you the sale of your capital transactions on the 1099-B, there's a few different categories. So most of the time when you're buying, again, say shares of Microsoft or Tesla or a mutual fund, the broker will track your basis and it'll actually send it to the IRS. It's called a covered security. So it's both saying how much you sold it for and how much you bought it for. For Arrive shares, we are not. So first point is this is a non-covered security. So we are not sending the basis to the IRS. So what we are doing is we are tracking the basis, but we're sending it as informational only. It's technically the investor's responsibility to track their own basis, but we are providing the information we have to make it easier for the investor to do so. But it is not submitted to the IRS. When Jake showed that 1099-B, you guys probably didn't notice, but there was a little box check saying that this is a non-covered security, and that's exactly what that means. We report the sales proceeds to the IRS, so how much you received, but not the basis.
Awesome. Yeah, excellent question, Cheryl. Definitely appreciate it. I am seeing a few repeat questions. We'll be sure to send out the recording as well. So Dora, we walked through 1099-B earlier and then also took a question on it, but you'll have a great resource post-webinar as well. Moving back over here, I believe we walked through depreciation again. So for Sandeep and Charles, we covered that one. I believe there was another one in here from TJ. Is there a difference between Arrived REIT and typical mutual fund REIT other than diversification? Joel, I'll also kick that one to you, and we'll get you in the mix here, Jake.
Yeah, so I mean, again, a REIT is just a tax concept. You have to hold certain kind of assets and get income from renting out property, and you have to distribute your 90% of your profit. So that applies to all REITs. They do differ in the types of assets they have. You can get hotel REITs and apartment REITs and office and industrial REITs. So that does vary. They also vary between whether they're public or private. So our REITs are private, meaning they're not traded on an exchange. So the price doesn't change daily and you can't just buy and sell at will. So there's a lot of public REITs out there which trade like stocks, where their value changes kind of on a daily basis, and you can buy and sell anytime you want. So that is one key difference. As a general rule, private assets often yield better than public assets due to something called the liquidity premium. People will pay a little more for an asset that they could, just hit a button and sell, and that drives down the yield a little bit. So there's lots of kind of research and articles on that general topic, but at Arrive, we're private REITs and we're in the single family residential space. And those are really the two characteristics that make it different than most of the other options out there.
Fantastic. Awesome. Seen some great questions continue to flow through the chat. Absolutely love to hear it. Moving back over here, I did see quite a few questions still on what tax forms we're getting and when. So I saw Praveen said, but I see the Schedule K3 on the tax documents. Can I disregard that and then just use the 1099-DIV?
Yeah, I don't think we sent a K3. I hope not. A K3 it just was introduced a couple of years ago. K1s were complicated enough as they are, and now these make these things very hard to understand, and it has to do with, I think, some international tax, and I can't even really give a good solid explanation of what they are, but they apply to, again, when you're in a partnership or an LLC and you're getting your share of the income and expense and all the other items there. So that does not apply to Arrive. That's why we love our 1099 divs. They are very, very simple. They're always on one little tiny box, and there's 8 fields, and we use like 3 of them. So that's all I can really say about that.
Well, huge kudos and thanks to you, Joel. We wouldn't have 1099 DIV set up if you didn't build that foundation and make it so easy for folks. So appreciate it. I know a lot of us have had to deal with K1s over time. A few folks in chat, it's a big headache that we'd like to avoid and want to make this process as easy as possible, especially when it's a passive investment. There's no point in having to deal with more barriers when you're working through taxes as a rule. All right, I did see a double on this question in terms of reporting, and I do think it's important when we're thinking about investing, so I want to double down on it. Ratul asked, do we get to see the financials of what property we have invested in on a quarterly basis? Jake, I saw you shared some details in chat. Would you just mind doubling down on that?
Yeah, as far as the financial performance, we have 2 sets of financials that we publish every year that are both publicly available. There's a set of non-audited financials that covers the first 6 months of the year for all of our properties. And then there's an audited set of financials that covers the full 12-month year. Our team's working on the audited set for 2023 right now. Those will be available later this month. They're linked to from the Arrive site, available publicly through the SEC's site. So even if you're not an investor in a particular property, you can dive through and kind of check out, what the financial performance actually looks like. It's not down to the specific line items, but it does kind of group things by category. So you can see what the repair expenses were for a property. You just don't see the breakdown of what was for that HVAC versus the flooring repairs and that level of detail. It doesn't match exactly to the tax forms that you receive, just with some nuances between book and tax accounting and the way that we have to kind of get things done come January. So it's not like you'll be able to just say I own 1% of this property, and therefore here's 1% of the earnings on the kind of SEC published financials, because there's a couple extra details and things that go on underneath the hood to make that tax reporting happen correctly. You're muted.
Shoot, I was doing so good. Thanks, Jake. Wonderful that you walked through that. Also, Jake shared, Brett shared a link to Portfolio View. A little bit of context there. We're told once you invest, you'll be able to see your performance on your properties so far in your portfolio. I'll also say I linked our filings above too. That'll have the reports that Jake is referring to, those financial reports to take a peek at. All right, moving back over to chat here. All right, this one's from Mark. It's a good one. We saw quite a few questions on this. Why did I receive such a small dividend on my investment of $100? Can you explain to me how I can make money with your system if it's only $1 every $100 that I get to invest? Maybe Jake, we can walk through why that dividend is small. I realize this one's a little bit off base, but I think it's a good one to touch on nonetheless.
Yeah, I can take this. The reality is that if you make a minimum investment for $100, and right now the single family residential fund is paying out dividends are about 4% per year. Well, $4 on $100 is going to be $4 of rental income per year. We pay that out monthly, so you'll be receiving something like 34 cents a month every month for 12 months. And on its own, that doesn't seem like a huge amount of return, but partially, you have to look at things in percentage terms, because what kind of dollar deposit dividends you receive depends on how much you actually invested. And the Arrived investments purposely have a low minimum so that people can get started and can contribute over time without needing to save up, $50,000 or $100,000 to go put a down payment down on a rental property. But certainly, the investments are not set up to be something like crypto or meme stocks where you invest $100 and it might triple overnight. Real estate in general is a slow and steady game. And so, the trick is not to make $100 investment and, hope that you'll be able to retire off of that, but to be able to kind of get started investing in real estate and then make additional investments over time so that you can build up a large enough portfolio that can spin off a more meaningful stream of passive income. So the returns are all done proportionally. So if someone invests $10,000 into a property and someone invests $100 in the exact same property, they'll both receive the same percentage returns. But obviously, if you invested $10,000 instead of $100, you'd own a lot more shares and therefore get a much higher dividend amount back as a dollar deposit.
Fantastic. Awesome. Always a good question to walk through. We recognize you all have a myriad of different ways to invest, so we always recommend asking all the questions and definitely attending as many webinars as you like. I know we have a lot of existing webinars that like to join our standard ones just to ask as many questions as possible. All right. And I see Cameron also shared some great details in the chat as well, which we definitely appreciate. All right, moving back over. Good one to clarify here. This one's from Steven. And then I also said that I saw that Charles asked if there's going to be another section on vacation rentals. We did walk through that in prepared remarks. It's pretty light, but if you have any questions regarding vacation rentals, feel free to drop in the chat. We can definitely answer those. Stephen asked, did you say that the rental income on vacation rentals is taxed at capital gains? I believe there was one more. I'll follow up after, but I'll kick this one over to you, Joel.
Yeah, so that is true on your own return, but know that we've already paid some corporate tax. So it reduces the amount we have to give in dividends. So again, use the Microsoft example. If you get a dividend from Microsoft, it's at the capital gains rate, but Microsoft has already paid 21% tax on the profits. So again, when you add it all together, it turns out to be the same. It just spreads out the liability between the company and the investor versus a REIT, which is a pass-through. It passes everything to the investor. So it's only taxed at one source.
Fantastic. Jake, did you have any color on that one?
No, it just ends up being 6 of one, half dozen of the other. Get a larger dividend and owe more in taxes, or get a smaller dividend but owe less in taxes. And at the end of the day, it mostly ends up being a wash.
Fantastic. And this was a follow-up I was looking for. They mentioned, but we don't need a track basis because you had to in order to tell us the gain. Is that correct?
Again, we are providing this information kind of like as a informational basis. Again, it's as a general rule, it's always investors should track their own basis in their investments just to be sure. Again, we are trying to make it easy as possible, so we are sharing what we have in our records, but I would do both, and to really understand where your investments sit.
Definitely. Yeah. Great question. Let's see. Charles had said, we'll throw this one up on stage for a second and we'll be happy to work with you. Charles said, I started investing in single family residential properties last quarter of 2023. I don't recall getting a tax form. Is that normal? Jake, maybe you walk through the nuances that can happen there.
Yeah, my hunch is that if you started investing toward the end of 2023, you probably didn't receive any dividends in 2023. So if you're just starting to receive your first dividends in 2024, then that's the first tax year in which you're receiving a payment. And so the first tax year in which you'd start receiving tax forms from Arrived. If you just invested in something on December 31st and you hadn't gotten any kind of a dividend, then you wouldn't have any tax forms for us, at least for this year.
Fantastic. Awesome. Charles, if that's an error in any way that you have received dividends and not seeing your 1099, feel free to ping support@arrive.com or use our chat function in the bottom right-hand corner of our platform. We'll be happy to look at that. I'm curious, though, if you have any vacation rental questions, as I know that's what you were interested in, we're happy to jump through those. I did see, I think we have time for some 101 questions. Jake, did you see that I missed any? I did miss one. Here we go. Let's see. Stephen had said, if our basis changes, are you saying that the change in basis as they occur and how often they likely change? Joel, can you touch on this one?
Yeah, the only thing that changes your basis is receiving a non-dividend distribution. So if you invested $100 and got $3 in non-dividend distributions, your basis would be $97. So if you then sold your shares, whatever it would be whatever you sold them for, less 97 would be your capital gain.
Perfect. All right. If you had a tax question in chat and I missed it, I apologize and let me know. We'll give it a few more moments here just so we can make sure all your voices are heard and all of your questions are getting answered. We're more than happy to. I saw a few standard questions that Cameron Wu has been able to step in on, as well as Brett, which is absolutely fantastic. A quick one in here. Is there a tracked way of performance of Arrive versus S&P 500 ETF? Jake, what are your thoughts here?
We've got something that we're working on, not something that we've publicly posted yet, but stay tuned over the next couple months, and we're hoping to have some better kind of comparisons and ways of aggregating the Arrived returns overall, so it's easier to compare to some of those other benchmarks.
Absolutely. Yeah, so great feedback there. As mentioned, we are built on that, so it's super helpful for us to hear what you would like to see over time, especially comparing to different investment types, whether it be more traditional or newer investment types with fractional. All right, going back, Stephen's got one more in here, I think. Mm-hmm. And Joel, I'll kick it to you. And then in our account, it would decrease the basis too.
I might need your help on this one, Jake. I don't know that we're showing that in the account screen. It's not a tax basis thing. It's more of a, what is the value and what compared to what you originally paid for it. But
yeah, we're not showing the tax basis in the portfolio. It's all just the market value of, what our estimate is for the securities that you own. But as we get closer to our kind of first redemption window for the single family fund and potentially to that, secondary market for IPOs, we'll kind of better have more data available to showcase to investors what your basis is, which, like Joel was saying, is really just a combination of what did you invest and what are the non-dividend distributions that you've received in the past. But we should be able to kind of put those all together to kind of give you a showcase. You can kind of estimate what your gains end up being when you do go to exit the investment.
Fantastic. Yeah, Stephen, great questions. I'll give it a moment there just in case you have any follow-up and we want to jump back into it. We're more than happy to. I think we cruised through most of the questions here. I saw a few on hold period, which we were able to walk through in chat, but let us know. We'll give it a few more moments here. I did see one, I did get a DM earlier that I missed. Are there any tax benefits of investing in Arrive versus stocks or other types of investments? Joel, I'll kick that one over to you.
Yeah, I think it's what generally applies to investing in real estate is that you get the tax-free cash flow with the depreciation, and then of course long-term capital gain rates on the appreciation. So those are the biggest tax benefits from a tax point of view.
Fantastic. I think we cruised through most of the questions today. I'll give it a few more moments. Jake, anything you're most looking forward to coming up on Arrived? I know this is a little outside of tax, but would love to hear what your thoughts are.
Yeah, I'll give the slight preview that we're getting ready to launch a new investment option over the next couple of weeks. It's going to be structured the same way as the single family residential fund, but instead of owning the properties themselves, it's actually going to go out and own the loans that different real estate entrepreneurs and operators are taking out to do fix and flips. So it'll be a private credit fund where instead of investing in the properties, we're actually acquiring loans, collecting the interest payments that folks are making each month, and then distributing that out to investors. We'll have a lot more information and content as that comes out over the coming weeks, but tax-wise, it ends up being very similar. It'll also be a REIT, so you'll get the same kind of pass-through taxation benefits, the same qualified business income deduction for the next 2 years. The biggest difference will be that it isn't actually owning the property, so there isn't any depreciation. So it'll be another kind of investment products that we get to add to the mix, and a cool way for investors to be able to invest in a different spot in the capital stack when it comes to residential real estate.
Absolutely. Yeah, more to come. We're going to have another taxes webinar too, to walk through all the details that relate to the private credit fund. So stay tuned. We're very excited. That is a product that we're bringing to light due to investor feedback and giving even more options to diversify the equity that you have. So we're very excited. Ron said, good idea on loans, I'm hearing. We feel the same. I'd be curious too, if there's any other questions on that, we're happy to jump into it. Let's see, there's two in here. One is related to taxes and one isn't, but we can take both for sure. Ron had asked, how do we get the vacation rental investments faster? Jake, maybe we walk through our SEC process, and then I can walk through a little bit more on the notification side.
Yeah, we're working on it. We are actively acquiring a couple of new vacation rentals that we are kind of putting the final touches on as far as design, construction, getting them all kind of rent ready so we can post them on Airbnb. We've got one that's posted on the site, so you can take a look at it for right now, but I don't yet have an estimate for when it's going to be available. But our team has been really sharpening up on the vacation rental operations and getting ready to expand that portion of our portfolio over the coming months.
Absolutely. Definitely stay tuned. Let's see here. If you haven't already, Ron, if you go to any of the 3 coming soon properties, I believe it's the Arlo, the Glencrest, and the Beatbox. If you click on those properties, and then there'll be a notify me button. You can select text or email. If you want both, just go ahead and select one, and then we'll be able to help you with the other one. As a note, you don't need to click on just the Beatbox or just the Arlo. We'll notify you for any individual properties coming up. And Ron said they keep monitoring the vacation rental one, and it's limited. Definitely for context, you can only see the coming soon button. Once you click in, there should be a notify me button. If there's not, feel free to use that chat function in the bottom right-hand corner of the platform, and we'll be able to help you there. Not a problem. I did see one in here from Chris. Would it be better to file dividends from Arrived as a personal income or file the income under my LLC for rental properties? Joel, I'll kick that to you.
Yeah, I mean, there may be something about the individual situation that I don't really understand, but in general, if an LLC earns dividend income, it just passes that dividend income to its shareholders, whether it's a single member LLC or a bunch of people. And there is a specific allocation for dividends. So the character remains the same. If the LLC makes dividends, it passes dividends to its investors. So it really, in theory, it shouldn't matter from a tax point of view, but I don't want to just say that definitively without knowing the big picture.
Absolutely. Yeah. And I'll say too, from an Arrived investment experience, there's really no difference if you're choosing entity, retirement, or personal from an investing experience on Arrived. Of course, we aren't professional advisors or tax professionals either. So we always recommend consulting as we're not able to make recommendations for your account. But if there's any questions, we're always happy to answer them for you. Ron had said, certainly down the road, a 1031 exchange would be great. We agree. We dropped a poll, Ron, to gather interest. It looks like 62% are interested in this. 38% said no. And I also dropped a link for folks to fill out more information on this. Jake, was there any clarification that you wanted from folks in regards to 1031s while we have everybody on the line?
No, that's all for now. If you own a property yourself that you might be interested in exchanging, please fill out that Google form. And a couple of quick questions on how many properties and when you'd want to sell. We're actively exploring options to help investors facilitate 1031 exchanges. And so we're just kind of getting some information and kind of adding together a list of folks that we are expressing interest, so that, as we develop the details of what exactly that exchange program works, we kind of have some data on what you're looking for and who to reach out to. And that way we can help you kind of exchange out of your current properties, avoid taking the big capital gains hit right now, and facilitate you buying another investment property.
Fantastic. Well, it looks like we just reached the top of the hour. I believe we cruised through all the questions here. Keep me honest in the chat if we missed any. And Sue, thanks so much for the kind words in chat. We definitely appreciate it. I'm very excited about the private credit fund that's coming up. Now the questions are coming. I feel like this is always in the wheel. Jake and Joel, are you okay on time if we answer a few more?
Sure.
Perfect. Ooh, it looks like this might be a little more on the personal side. I'm looking for depreciation for my personal taxes. Are there any programs available that can get that depreciation to me?
Yeah, I mean, we have covered this a little bit. The depreciation already happens at the corporate level. So when you get your 1099, which shows how much of your dividends are taxable, depreciation has already been factored in. So that's why we have the non-dividend distributions.
You basically can't distribute a loss. So you can't use any excess losses from Arrived investments. You can partially carry forward to future years and offset future Arrived income you earn. But unlike a partnership, there is no way where you can say, hey, look, I had a $5,000 loss on my Arrived investments, and so I can use that $5,000 loss to offset income elsewhere.
Yeah.
It's part of the give and take of the 1099 DIV structure versus a K1s.
Fantastic. All right. I saw one in here from TJ. TJ, I'm going to walk you through out loud. You can follow along here. If you go to the Arlo or the Beatbox or any of those coming soon properties or any existing properties to date, if you click into that property page, it should auto default to details at the very top. Then if you scroll all the way down, you'll notice that we have the document section. So the very last one is the offering circular. And then Jake just did a super quick link to our circulars that you can take a look at as well. All right. Ooh, I do see one. Let's see here. What happens? We got some good ones coming in. What happens to the losses we can't use? Do we benefit eventually? Joel, I'll kick that one to you.
So again, as long as you're in the fund can use the losses from a prior year to offset future years. So you will get that benefit by staying into the fund. It'll just, even if we make a profit the next year, we could use the prior year losses or 80% of them. If you're talking about if you end up having a capital loss somehow where you sell shares for less than you bought them for, then that goes onto your individual tax return. And the rules on what kind of losses can offset other kinds of income are fairly complicated. There's capital gains, long-term and short-term, and interest income, and dividend income, and earned income, and passive income. And there's some things offset and some things don't. But again, for our main operating losses due to depreciation, you get the tax-free cash flow, and it'll offset future years. So that's really the most important part of it.
Fantastic. Jake, I did see one in here that, since we have a little bit of time, for Paula, and I also recommended coming to our standard webinar as well. They mentioned that they're new to this and interested in vacation rentals, but unsure how it works when the rental isn't rented. Could you walk through, essentially this applies to all properties that we have, if there's any vacancy, how it can impact returns and dividends?
Yeah, in general, the returns investors receive end up being very reflective of the actual performance of those properties. So if you invest in a long-term rental and it takes a long time to get a tenant in, then that might mean you're not receiving dividends until we actually get a tenant in that property, start receiving those rent checks and generating that cash flow. It's the same situation for the vacation rentals, particularly those properties. They can take a little bit longer upfront because we're kind of ordering all the furnishings, we're getting all the amenities in the property, and really getting it ready to have an excellent experience for vacationers on Airbnb. And so during that time, when we're getting the property set up and ready and ready to be bookable on those sites, there may not be any dividends to investors. Once that property is starting to kind of see some performance, it's starting to book out on Airbnb, it's collecting rent, it's paying expenses, then that's when we'll start those dividend payments to investors. In general, that's how it'll work for the vacation rentals and the long-term rentals. As properties generate a bunch of cash, we'll distribute the income out to investors. If properties have higher expenses than we may be anticipating, then we may decrease or pause dividends for a moment while we kind of get those properties back and situated.
Fantastic. Looks like we cruised through most of the questions. I saw Brett had answered here, so I think we got all of them. Joel, any closing remarks? And Jake, before we shut our virtual doors for the day?
No, just thanks for all the great questions.
That's all I've got. Thanks, folks. Awesome session.
Awesome. Well, thank you folks for joining us for an hour 5. It was absolutely fantastic. We definitely appreciate it. Joel and Jake, so appreciate the prepared remarks and then walking through the diversity of questions. If there's any, perfect timing for the investor that just said missed most of the presentation, when's the next one? We will be sure to send a recording out to all folks today for you to take a look at. Lots of questions that we walk through will be in those prepared remarks as well. I'll also say too that we host typically our standard 101 webinar 2 times per week. As mentioned, we always have a lot of investors that like to join those, typically 20 to 25 minutes after prepared remarks, just to get questions answered. So definitely appreciate having you all. If there's any questions after the dust settles, feel free to ping support@arrive.com or use our chat function in the bottom right-hand corner. But thank you again also to our Arrive team for jumping in here and for all the kind words in chat I'm seeing now. Definitely appreciate it, and hope you all have a great rest of your day.